Hey everyone, welcome back to Corporate Decoder, the place where we unpack and make sense of the latest financial news. And let me tell you, Elme Communities has a doozy of a report for us today, hinting at a complete shakeup. This report is all about a massive pivot, a planned sale of almost everything, and a big goodbye to being a real estate investment trust as we know it. Let's dive in and see what it all means for investors. This filing is a quarterly report, specifically for the period ending the 30th of September 2025. It gives us a snapshot of Elme Community's financial health right at the end of the third quarter. As of the 21st of October 2025, Elme Communities had a little over 88 million shares of common stock out there. This is important because it forms the base for calculating earnings per share and other key per share metrics. Let's start with the balance sheet, which shows what the company owns and owes. As of the 30th of September 2025, the company had about $1.64 billion in real estate held for investment. This figure is down from over $1.79 billion at the end of 2024, suggesting some properties might already be on the move or valued differently. Overall, total assets stood at around $1.68 billion on the 30th of September 2025, compared to $1.84 billion at the end of 2024. This decrease is a clear sign that the company is shrinking its asset base, which aligns with the upcoming sale. On the flip side, total liabilities were about $777 million, a slight increase from $763 million at the end of 2024. This means while they are selling assets, their debts are still in place and are even growing a bit. Shareholders' equity took a pretty significant hit, dropping from $1.08 billion at the end of 2024 to $909 million in September of 2025. This is largely due to a big jump in distributions in excess of net income, which is basically a fancy way of saying they've paid out more to shareholders than their earnings have supported recently. This aligns with the plan to liquidate. Now let's look at the income statement, which shows how the company performed financially over a period. For the 3 months ended the 30th of September 2025, rental revenue was about $62.1 million, just slightly up from $61 million in the same period last year. Not a huge change there. Revenue is relatively stable from operations. But then we hit a wall with real estate impairment at $111.7 million for the 3 months ended the 30th of September 2025. This is a massive one-time hit to earnings, meaning they've had to write down the value of several properties significantly. This is directly linked to the upcoming sale and the plan to liquidate, and the consequence of that impairment charge, a net loss of $123.5 million for the quarter, compared to a much smaller loss of just $2.9 million in the same quarter last year. This is a dramatic shift, and it showcases the impact of that impairment. For the 9-month period, the net loss is a staggering $131.7 million. Compared to $10 million in the prior year. This translates to a loss of $1.4 per basic share for the quarter ending the 30th of September 2025, a huge plunge from a loss of just $0.03 per S-share last year. This shows how that impairment is directly impacting shareholder value on a per-share basis. Looking at the equity statement, we see a clear picture of what is happening with shareholder value and claims. Notice the distributions in excess of net income line. For the 30th of September 2025, it is negative $825 million. Compare that to negative $646 million at the end of 2024. This growing negative number signifies that the company is distributing more capital to shareholders than it is earning, which is typical for a company in liquidation. The cash flow statement tells us where the company's cash is coming from and going to. Here, the net loss for the 9 months ending the 30th of September 2025 is $131.7 million. But when we look at the adjustments, that $111.7 million real estate impairment charge is added back. This means that while it significantly hurts net income, it does not represent an outflow of cash in the current period. Despite the massive net loss, the actual cash provided by operating activities for the first 9 months of 2025 was over $61 million. This positive operating cash flow, before considering investing and financing, is noteworthy. However, it is lower than the $70.7 million in the same period last year, indicating operational cash generation is slowing. Investing activities show that capital expenditures, meaning money spent on maintaining and improving properties, were about $23.1 million for the 9 months. This is less than the $29.6 million spent last year, which makes sense if they are winding down operations and property values are being reassessed. Financing activities show a net cash outflow of $38 million for the 9 months ending the 30th of September 2025. This is mainly due to dividend payments. Let's dive into the crucial details that explain this financial picture. This section is the heart of what is going on. On the 1st of August 2025, Elme Communities entered into a major agreement to sell a significant portion of its multifamily properties, about 19 of them, for $1.6 billion. This is the portfolio sale transaction, and alongside this sale, the Board of Trustees approved a plan of sale and liquidation. This means the company is not just selling assets, it is planning to completely shut down operations and dissolve. This whole plan hinges on shareholder approval. If the shareholders vote yes, the company will proceed with selling off its assets and liquidating. To facilitate this massive shift, they've secured a commitment for debt financing. They've got a commitment letter for a loan of up to $520 million, which will be secured by whatever assets remain after the main property sale. This loan is intended to provide liquidity while they sell off the remaining pieces. Here we see more detail on the real estate side. This is where that huge impairment number comes from. They had to write down the value of properties they are not selling in the big portfolio deal. This means these properties are now considered worth much less than their book value. The reason for the impairment is that management revised their estimates for how long they would hold these properties, and consequently, the expected future cash flows were lower than their current value on the books. This is a classic sign that the market value has dropped or future prospects have dimmed for these specific assets. This is important. When they valued these impaired properties, they had to use complex models with inputs that are not readily available in the market. This level 3 classification indicates a higher degree of subjectivity and estimation involved in the valuation. It means management is making educated guesses based on their own projections. Elme Communities uses financial instruments to manage risks, particularly interest rate risk. Here we see the values of their interest rate swaps. As of the 30th of September 2025, they had a net liability of $315,000 in these swaps, and at the end of 2024, it was a larger liability of $913,000. Swaps are contracts to exchange interest rate payments. A liability means the current market conditions make these contracts unfavorable for Elme to hold. This is tied to their debt obligations. This section breaks down the company's performance by its operating segments. Elme Communications considers itself to have primarily one operating segment, the residential segment, which is all about apartment communities. Their office property, Watergate 600, is so small relative to the rest of the business that it is lumped into an other category. It doesn't qualify as a separate reportable segment. These tables show the financial performance of each segment. And importantly, they help us understand how the impairment charge impacted things. NOI, or net operating income, is a key measure for real estate companies. For the 3 months ending the 30th of September 2025, total NOI was $37.9 million, a slight decrease from $38.8 million in the same quarter last year. This shows that the core operations before those big impairment charges are holding relatively steady. But again, we see that $111.7 million real estate impairment charge for the 3 months ended the 30th of September 2025. This is the elephant in the room, overwhelming all other operational figures. This is where management explains the numbers in their own words. This section always starts with a disclaimer about forward-looking statements. It is essentially a warning that the future is uncertain, and things might not go exactly as planned. Given the planned liquidation, this disclaimer is especially crucial. And here is the candid part. Management is upfront about the risks associated with this massive sale and liquidation plan. They acknowledge it could negatively impact everything from employee retention to relationships with tenants and vendors. They are aiming to wrap up selling off everything else by June of 2026. This gives a timeline for the full wind down. They are also warning that tons of money will be spent on this process itself, regardless of whether it actually goes through. This is the cost of doing business when winding down a company, and this highlights the board's ultimate control. Even if shareholders vote yes, the board can still change course if they believe it is in shareholders' best interest. This adds a layer of uncertainty. A key risk here is that selling properties could trigger a 100% penalty tax if deemed a prohibited transaction, like selling inventory. They are trying to avoid this, but it is a real concern. This is the bottom line for shareholders. These potential taxes and other complications mean the final payout might be a lot smaller than initially hoped. This section reiterates and expands on the risks, and as expected, they're bracing for lawsuits. They mention that actions like this often lead to shareholder litigation, which can be costly and divert management's attention. In fact, they've already got a couple of lawsuits filed, alleging misrepresentation in their proxy statements. This part talks about share buybacks. They bought back a small number of shares, 673, in July. This was mainly to cover taxes related to restricted share awards vesting, not an aggressive buyback program to boost shareholder value. They have a share repurchase program authorized, but it is unlikely they will use it extensively given the liquidation plan. So, what is the story here? Elme Communities is essentially liquidating. They've entered into a major deal to sell off a large chunk of their real estate portfolio and have a plan to sell everything else and dissolve the company. The financial results are heavily impacted by a massive real estate impairment charge, which is a direct consequence of this planned exit. While their core operations seem stable, the overshadowing factor is the impending liquidation, which brings its own set of risks, costs, and a lot of uncertainty for shareholders about the final payout. They are moving from being a real estate operator to a company focused solely on selling off assets and returning cash to shareholders, a process that will likely be complex and lengthy. This is a company in transition, a very drastic one. The big question for investors is not about future growth, but about the efficiency and fairness of this liquidation process and how much of their initial investment they will actually get back. The large impairment charge signals that the market value of some of their assets has significantly fallen, and the planned liquidation could be a necessary step to unlock whatever value remains. Alright, that is our breakdown of Elme Communities' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.